let me start recording. Shri Guru Bhyo Namaha Om Shri Ganeshaya Namaha. Good evening, friends. I am your B.N. Venkataraman, the inventor of InflaPro, Inflation Protected Return on Investment. This is the retirement planning series, and this is session 10 about summary of what all we have seen so far and revisit of SIIP, Systematic InflaPro Investment Plan, and SIWP, Systematic InflaPro Withdrawal Plan, and thumb rules. In session 1, we had detailed Google Sheet and the usage of goal seek is demonstrated. The sample case considered is for person of age 30 earning about 60,000 rupees per month. We have considered the current expenses for the couple would require 35,000 rupees per month in their entire life. This would mean an expense of 2.01 lakh at the age of 60. 35,000 rupees per month is the current estimate. This would be 2.01 lakh at the end of per month at the age of 60. The goal seek add-on Google Sheet of the given target has calculated and the investment at the starting age of 30 to be 1,26,727 per annum or approximately 10,560 per month. That is about 17.44% of the income. Also, customer-friendly web-based calculation to budget accurately is also explained in that session. However, it has also been outlined that spreadsheet has advantage of dynamically evaluating how much to invest from that time onwards on fly based on actuals. Therefore, it is advisable for investors to master the preparation of the spreadsheet. In session 02, that is the session 01 continued, it has been explained how to achieve our desired minimum 11% in investments. I have also explained about my investments and at age 74 how I got around 12.3% was indicated and reported below. I am a minuscule investor and at age of 74, current age of 74, I have following asset allocation and returns as per the table below with huge percentage on fixed income category of Prime Minister Venkataraman Yojana, Senior Citizen Savings Scheme, etc. That is, my fixed income allocation is about 57%. I have equity of about 28%, mutual fund equity of 15%. The returns from equity is 20.31%, and mutual funds equity is 10.95%. There is a negligible mutual fund debt funds. Fixed income return is only 8.35% and net return is of the order of 12.3%. The idea is to show that 11% return is practical. This above is for 3-year performance as of 10th August 22. However, I have advised the viewers to approach personal finance advisors for best allocation in order to get best return, who will consider various parameters like your age, risk appetite, etc., and also will be able to generate around 14% return for your funds. Also in the same session 01 continued, I had reasoned out my assumption of 6% inflation in our calculations based on the government figures of cost inflation index since 1981. Since 2014-15, the cumulative inflation percentage is go on decreasing from 7.30% steadily to 6.67, current 6.67%. In session 0203, we had discussed about monthly premium. So far in 01, we had considered only yearly premiums. This saving percentage worked out to be 17.44% of total earnings. In session 0203, we considered monthly figures of above with expense figures to be 35,000 rupees per month and 51,000 rupees per month other expenses respectively, and the rate of return be 11% per annum per month monthly compounded, and the monthly compounded is 11.572% per annum yearly compounded, which is attributable to the decrease in calculated savings figure, With this, we arrive at saving of 16.18%. That is from 17.44 with monthly premiums, we are coming to 16.18%, and in another table 15.28% with reduced inflation percentages. In session 0203, we have also outlined about the employees of organized sectors. For persons who are employed in government and other organized sectors, there is a saving of 12% plus 12% of basic plus DA as employee contribution and equivalent employer contribution to their PF and PF schemes, which get a return of around 8.25%. These savings alone would be inadequate for the retired life with the kind of inflation price rise we are experiencing now. Even for them, apart from this 24% PF, an additional saving is required at 60,500 rupees per annum or 5,300 rupees per month, or 8.87%, say 9 to 10% of earnings in 11% return category in their portfolio management for this salary group of approximately 60,000 rupees per month earners. The same figure with monthly premium works out to rupees 4,500, approximately 7.5% only. The 24% EPF, PPF, NPS can generate only around 50% of the corpus required and our wise investment of 7.5% earnings generated around 50% of the corpus. That is 24% of your corpus, 24% of your contributions or investment could generate only 50% corpus, whereas our 7.5% in wise investments can generate under 50% of the corpus. So, one can very easily infer that PPF, EPF, NPS is unwise and inadequate. We had discussed in the previous sessions, session 4 summarized. We had discussed in previous sessions of spreadsheet 01, 02, 03, and now let us discuss the retirement planning with single premium in spreadsheet as well as author's web-based software. The outcome of the investment particulars in the session 04 are listed in the following table with annual periodicity in single premium, because monthly periodicity would require a longer spreadsheet. To show their spreadsheet equivalent, I have just taken up this annual periodicity. Current age. If its current age is 30, investment, one-time investment has to be 21.07 lakh for the corpus to be generated after 30 years as 4.82 crore, and cumulative post-retire expenses is 13 crore, and maturity factor is 429%, both in both the annual cases, and maturity after allowing for retire expenses, that is 55 years after the current age of 30 and at the age of 85 is 20.70 crore. Same figure at the age of 60 would be one-time investment would be 84 lakh, and the corpus generated would be again same 84 lakhs, because the single time investment and the current age is 60, and the cumulative retire expenses is 2.3 crore, and maturity after allowing for retirement expenses is 3.6 crore. Combined would be 5.91 crore. We had discussed in the previous sessions of 01, 02, 034, and now we discuss the planning of child's education in SPREADSHEET as well as author's web-based software. This is for another goal. This was discussed in session 05. One has to start planning to save child's education right from the age 1 of the child, even though one cannot guess which stream, whether science, engineering, law, medical, etc., the child will pursue. At that age, one has to consider a moderate fee at current level and plan accordingly. College fees at present varies from college to college, city to city, from around 1 lakh to 15 lakh per annum. I feel saving of around 4 lakh prorated to 16 years ahead for a 4-year undergraduate level program will be a reasonable target for a person whose salary is around 60,000 rupees per month at current level. The corpus required after 16 years would be 68 lakhs. One has to bear in mind that educational expenses over the last 60 years have been increasing at an alarming rate of 10% compounded annually. With this in mind, let us see the spreadsheet. Now we are not going to spreadsheet detail, but we will see the effective table. Children's education is the first and foremost priority in the parents' budget. One has to build the goal corpus in a separate bucket, because this we are projecting for 10% inflation. Following tables show requirement of funds 17 years ahead. In 17th year, this present year 4.20 lakh per annum would be 19.30 lakh per annum, and it will increase 10% further years for the next 4 years, and we will consider the growth generation for this goal is 0, because we have estimated the saving for a particular goal, and we will spend it for the same goal, leaving nil balance. In order to fend for this high inflation of 10%, one has to look for an avenue of generating a revenue of over 12% on investment if the one is not skilled enough for it. It is better to seek the help of personal finance advisors, of course SEBI registered investment advisors. Never mind your investments are too low. Still it's better to consult a SEBI registered investor advisor. The corpus required at the end of 16th year will be 68.61 lakh. Inference. Current age of child is 1 age. Investment at the beginning of age is 79,796 per year, or approximately 6,650 per month. And the corpus that would be required after 16 years would be 68.61 lakhs, and total term is 4 years, including study period of 4 years. We have considered in some previous retirement planning, namely SPREADSHEET 010203, a sum of 15,000 rupees per month, 1,80,000 rupees per annum as current other expenses category, catering mainly to 2 children expenses, and it seems that figure seems to be inadequate with this 10% inflation. Until then, bye. Thankful. Okay. In SPREADSHEET 06, we consider the priorities in home budget in expenses. The essential expenses would cover food, clothes, health, house rent, conveyance, any personal loan repayment, interest, term plan insurance premium, of course, most importantly, charity. All this will cover into the essential expenses. Other expenses will take the highest priority, and children's education planning for higher education. Children's current educational requirements. These are the priority expenses, and one has to cut down or adjust the essential expenses, and has to have a little bit of constraint. We estimated that about 5% constraint would be there if one goes for vehicle loan, etc. Third would be investment towards retirement planning. Third priority would be towards financial freedom of at retired life until death. Fourth priority would be insurance premium, endowment schemes. Then the last priority would be home loan, vehicle loan, equated monthly installments. We had discussed about how to achieve 11% in return in one of the previous sessions, namely retirement planning 01 continuation and asset allocation. Now in this session 07, in Google spreadsheet about how to implement our technique of SIIP, the Systematic Inflow Pro Investment Plan, and Systematic Inflow Pro Withdrawal Plan, that is variable SIP, SIWP, within the purview of the current scenario, had been discussed. The technique is quite simple. To decide the periodical date of your instruction and give SIP, SWP instruction to your bank's mutual funds, the bill pay. With the bill pay, you can pay electricity, gas, mobile, telephone, insurance, credit card, and mutual fund under net banking. One can do mutual fund investing through this bill desk bill pay, and it is available in many banks 24/7 around the clock. However, high risk appetite people desire of investing with the stock market should be able to spare time once in a month to invest during SEBI working hours, or should have parent or portfolio manager to do the actual investment. The present scenario is that there is no product of Inflow Pro is available. sorry, there is mistake here, double negative has come. In this, the present scenario is that there is no product of inflow pro is available in the market, in the pension plan, mutual fund, stock market, as inflow pro is the innovative method developed by the author B.N. Venkataraman, myself. Even in SWP, even for 10 years in the present market, finance advisors at the maximum recommend uniform withdrawal of say 7.5%, where your return is of the order of about 4%. That is, nominal return is 7.5, 14%, and the actual return would be around 7.5%. The author suggests SIIP and SIWP in systematic inflow pro investment plan and systematic inflow pro withdrawal plan, and already outlined how to implement under current scenario and re-explaining and re-explaining and revisiting. SIIP is already available in PPF, EPF and NPS deductions at the rate of 12% from the employee and 12% from employer contribution on the basic plus DA for government and other organized sector employees. Similar pattern you can exercise your SIIP in your investment bucket. The author suggests separate buckets of portfolios for different goals such as retirement, children higher education, etc., with different risk appetite. SIIP, systematic inflow pro investment plan, is implemented as follows. Instruct your mutual fund AMC by logging into your account in their site by initiating bill desk bill pay to your banker for the desired investment amount, desired investment amount every month for every month for 12 installments. The investment amount every month, that is bill desk bill pay, as the SIP is for 12 months, every month for 12 months. Also, using your bank's net banking, honor the bill pay desk instruction on a scheduled date for 12 months. Now, after 12 months, you increase your investment as per inflow pro calculation or as per your spreadsheet works out, and repeat the execution of bill desk bill pay. Like this, you revise your investments year after year until you stop investing for the goal. The SIP amounts will be automatically transferred from your bank account to mutual fund schemes on scheduled date. Similarly, in case of SIWP, systematic inflow pro withdrawal plan, first you log into your mutual fund AMC website and execute SWP for 12 months of their scheme, on which you have already invested and achieved a corpus. After 1 year, repeat the process for next 12 months with revised amount and continue as long as you want or until death. Never forget to register a nominee for these schemes. The SWP amounts will be automatically transferred from mutual fund schemes to your bank account on scheduled date. It is exactly same as normal SIP, SWP, systematic investment plan or systematic withdrawal plan, normal one or conventional one, but for instruction for 12 months every year. In session 08, we discussed the retire plan priority to be higher than our own house loan priority, grammatical mistake. Discuss the retired plan priority to be higher than own house loan priority, and also discuss the return on real estate. The return IRR, that is internal rate of return, in the case of real estate works out to be of the order of 8% only, and is nowhere our desired return of 11% required for a retirement plan. In session 09, we discussed the right age of retirement and algebraically found that latest age to start retirement plan is 46. The table arrived at age 46 reproduced below. Current age 46, retirement age 60, that is 14 years for investment period, and current expenses prorated for a retired life is 35,000 rupees. Starting pension after 14 years of investment would be 79,132. That is, starting pension would be about 2.2 times. The starting investment is 13,300 rupees per month against 35,000 rupees current prorated. We will be investing around almost same figure, and corpus at the age of 60, that is corpus after 14 years would be 1.83 crore, and maturity or the accrual to the survivor or nominee would be 446% times, that is 8.13 crore. Here in this page the table is repeated for age 46. The amount of pension 79,132 per month after 14 years of current age 46 is just equivalent to 35,000 rupees of current cost of living for a retired couple. The investment starts at 33,600 rupees, just around the desired cost of living for the couple of 35,000 rupees. If one is less age, then one can make a starting investment less than this figure. Say for a 30 years aged person, the amount is only 9,660, not this 35,000 rupees. For a person of higher age than this, then he has to start investing more money to get a pension of lesser prorated 35,000 rupees per month. Say a man of 50, the starting amount is 52,650 rupees. He has got only 10 years to invest. Now, most importantly, we are coming to concluding page and thumb rule on SIIP, systematic investment plan, systematic inflow investment plan, and systematic inflow withdrawal plan. In our calculations, we have assumed a figure of 6% towards inflation and 11% towards desired minimum return or IRR or nominal return, so as to have withdrawal and growth of 4.465 times, 446.5%. The corpus in 25 years return after allowing for inflation and it is 5.214%. The thumb rule is your SIIP should be at the projected rate of inflation, say 6%, higher than the previous year. In SIWP, systematic inflow withdrawal plan, the rule is to withdraw in withdrawal plan. The rule is to withdraw the balance amount, say 5%, and the exact calculation is 5.214%. After allowing for 6% inflation protection on the previous year's return performance, say 11%. That is, If you earn 11%, then you withdraw only 5% after allowing 6% towards the growth. That is, this 5%, 5 plus 6% becomes the 11%. With this, one can see automatic growth as per SIWP Pro, that is 4.465% times or 446.5% in 25 years at 6% inflation. One can decide to withdraw less or more by deciding a non-auto pattern, say 400% growth in 25 years of retired life, and make SIWP accordingly using my calculation of SIWP Pro. In the case of 400% growth, you will have more amount to withdraw. One has to remember that the about 5.214% calculated in SIWP, its systematic SIWP Pro withdrawal plan, is equivalent to 8.362% in conventional SWP for just 25 years span with additional growth of 446.5%. Thanks for watching. Bye for now. B. N. Venkataraman. Let me close it.